Hello and welcome to Simply Nico episode number 4. My name is Nico Giovanni Romero, but you can simply call me Nico. This is a vlog where I share what I'm learning as I learn it, so if there's any time that you need further clarification on anything, please feel free to drop some comments. I'd love some feedback. For today, we'll be getting into some topics that are directly related to the current market, hint hint, and then we'll round out with some common acronyms that should round out some key takeaways for you. On that note, let's get started. Before we get into some refinance topics, I'd like to go over a couple different types of home equity loans. The first acronym we're going to go with is HECM, and that stands for Home Equity Conversion Mortgage, but we all know it as a reverse mortgage. And this loan is for borrowers that are 62 years of age or older, and it creates cash disbursements out of the home equity they've built up. The second type of home equity loan is a HELOC, which stands for Home Equity Line of Credit. The big thing here is that the borrower takes out a revolving line of credit based on the collateral built in the equity of their home, and it'll be a second mortgage. So you have your first mortgage. If you have equity built up, well then you can take a line of credit out based on that excess equity. So now let's jump into refinance, which is simply just a provision to your payment schedule for repaying your debt. So the first type of refinance we'll go over is a rate and term, which lowers your mortgage payment by either reducing the interest rate or extending the term or the amount of time that it's going to take for you to pay it off. The next type of refi we'll go over is called cash out, and like its name, gives you a lump sum of money once the loan is closed. First, the proceeds are used to pay off any existing mortgages, any closing costs, or any prepaid items like taxes and insurance, but then the remaining funds are free for you to use as you wish. The last two types of refis we'll go over is if you currently have a government insured or a government guaranteed loan. So the first one, if you have a current FHA loan, well then you can use an FHA Streamline to lower your mortgage insurance, your interest rate, and or your payment. And likewise with VA, you can use the interest rate reduction refinance loan, which does typically the same thing as the Streamline, but if you have VA benefits. The last concept we'll go over today is called loan to value, or LTV, which is simply just a ratio or percentage expressing the amount of money you're borrowing in comparison to how much your home is worth or how much you're buying it for. To give you a visual, the LTV is equal to the amount of money you're borrowing divided by either the appraised value or the purchase price of your home. So whichever is less out of what you bought it for or what it's valued at is what you'll divide by. For example, if you're purchasing a home for, let's say, $520,000, but the appraised value is only $500,000, well, we'll divide by that $500,000. So out of the $500,000 appraised value, if you put down $100,000, which is 20% down, then your loan amount would be 500 minus 100, which is $400,000. So the amount you're borrowing divided by the appraised value would equal the LTV, which is 80% LTV. Well, that's all for today. Thank you for tuning in. Like I said, if you have any comments or feedback, please feel free to drop that below. I'm happy to go over any concepts you guys have in mind. If I don't know it yet, I'm happy to learn it, because if you know me, I'm happy to learn and grow as I go through this. The next episode is going to be the truth about FHA loans. So stay tuned next week, which will be the first episode of 2021 for the next episode. Thanks for tuning in. Have a great day.